Good morning, everybody. Good morning. Welcome back to the Peterson Institute for International Economics. My name is Nicolas Veron. I'm standing in for Adam Posen, the president of the Institute, and I'm particularly honored and thrilled to introduce this session on the 27th report, Geneva Report on the World Economy, Much Money, Little Capital, and Few Reforms, the 2023 Banking Turmoil. I'm particularly thrilled because this is the kind of topic I tend to obsess about in my own research, basically financial stability and banking sector policy, but also because the Geneva Report is a landmark series in our community and profession, published by the CEPR in partnership with the International Center for Monetary and Banking Studies at the Graduate Institute in Geneva, which is why it's called the Geneva Report. And I was honored, Beatrice, to participate in that exercise 5 years ago with other co-authors. But before I get to today's event, let me just mention that this, of course, is part of the Peterson Institute for International Economics Macro Week. We already had a number of extremely thought-provoking events in Macro Week, and we'll have more coming up very soon. Later this morning, we'll have the Deputy Governor of the Bank of France, Agnès Benassi-Kéré. At 1 p.m., we will have the Governor of the Reserve Bank of New Zealand, Governor Adrian Orr, on monetary policy during periods of economic volatility. Agnès Benassi-Kéré, I forgot to say, will talk about monetary policy transmission across the euro area. At 3 p.m., we have a small country but very interesting story of Liechtenstein's path to IMF membership with the Prime Minister of Liechtenstein, Daniel Rich, and Jan Liu from the IMF, the International Monetary Fund. And at 5 p.m., we'll have the launch of another report, Working Together for Better Climate Action, a joint task force involving the International Monetary Fund, the OECD, the UNCTAD at the UN, and the WTO, the World Trade Organization. And this is only for today. I won't tell you the rest of the week because we want to get going, but there is even more coming up. We have 2 of the 5 co-authors of the report in the room today, and one very qualified and prestigious discussant. The report was co-authored by Ignazio Angeloni, Stijn Claessens, Amit Serou, Sasha Stefan, and Beatrice Weder di Mauro, and Stijn and Beatrice are here in the room. The report itself highlights that despite all the reforms that came after the great financial crisis and also the Eurozone crisis, there really is no room for complacency, as the cliché has it, and actually a lot of the frameworks that have been put in place after those financially earth-shattering events 10, 15 years ago have either not come to full fruition or not been sufficient to prevent severe dysfunction in the financial system, at least in the US. Also, the report will argue in Switzerland. And for that, we'll have, as I said, Stijn Claessens and Beatrice Weder di Mauro will present the report. Stijn Claessens is now an executive fellow at the Yale School of Management, which he joined last year in 2023. He has an extremely distinguished career both in academia and in public policy. He has a PhD in business economics from the Wharton School at the University of Pennsylvania. He has taught at New York University Business School and for a number of years at the University of Amsterdam. But perhaps even more relevant for policy, he has occupied senior positions at the World Bank until 2007, at the International Monetary Fund, then until 2014, then at the Federal Reserve Board until 2017, and then until last year at the Bank for International Settlements, the BIS in Basel, where he was deputy head of the Monetary and Economic Department. Beatrice Weder di Mauro is, of course, the president of CEPR, the Center for Economic Policy Research. which is based in Paris, I guess, at this point. She also holds the André Hoffmann Chair of Economics, Climate and Nature Finance at the Geneva Graduate Institute. She has taught at INSEAD, at the Gutenberg University in Mainz. She's been a member of the German Council of Economic Advisors, economic experts, and has advised numerous organizations around the world, including in capacities as board members. Last but not least in the program today, Stefan Ingves is chair of the Toronto Centre Board of Directors. He's been a governor of the Central Bank of Sweden for a very long time. He's, to me at least, a monument of central banking, if I can use that expression, Stefan, and a figure of authority. He has been the chairman of the board of the Basel Committee for several years and accomplished numerous breakthroughs for the Basel Committee in that capacity. He has also worked at the International Monetary Fund, before that at the Swedish Central Bank, and in other major public positions. But enough from me, and Stijn, I think you start first. Thank you.
Thanks very much, Nicolas, for that introduction, for the opportunity to present this report. It is with a bunch of co-authors, so I'm going to selectively present some elements because we cover quite a bit in the report. And the report really tries to add value. There's been many reports already written about the banking turmoil. What we try to do is, one, of course, fill the gaps that other reports may have left behind, but also look a little bit more at the structural issues that were driving the crisis that we saw last March, and what were the underlying fundamental issues. And the second thing, before I get started, is to talk about the title. In some sense, the title tries to capture what we have learned, is that in essence, there was way too much money relative to the amount of capital in the system at that time. So we had big QE and other asset purchase programs in the COVID period. That led to a large influx of liquidity, and that came back to haunt, as often does that, in March 2022. Also 23, relative to the reforms that were way too few. Where I'm going to be talking about is two regions, countries. It's Europe and the US. And let me start by giving you this little picture here. March 2023 was not a small event. We can maybe look at the mirror and say, well, it happened, it was a little blip, etc. In terms of dollars, in 2023 dollars, it compared to the SNL crisis in the 80s, early 90s. And it is not that different from the GFC in 2008. This was an amount of about $300 billion in 2023 dollars. So a significant event that we should not simply ignore and saying it was a little bit of a run at a few banks. Yes, there were only a few, but as I will show you later, there were many other ones in the same position. Credit Suisse, and Beatrice will talk a lot about the particular case of Credit Suisse in Switzerland, was a major event, of course, for the national economy. You see here all the main characters that were gathered on the Sunday at the press conference, the Minister of Finance, Central Bank, regulator, and the new combined merger, UBS. So with that as an introduction, the report is large. There's a lot to cover. I'm only going to be very selective. This is the overall outline. I'm going to talk about a little bit of a reminder of where we were in March 2023, what happened exactly. Most people know very well, but just to take a stock also of the reforms that were in place at that point and what we have seen since, to highlight that we have not completed the GFC-induced agenda, Basel III, and all the other reforms. And then I will talk specifically on the US and on the European banking system. What was the underlying fundamental drivers of the vulnerability, particularly on the US side, and then Beatrice will talk on the Credit Suisse following me. So just as a reminder, since all of us were here, three things about what transpired in March 2023. One was the speed of outflows, very high, the 40 billion that was going to come out of SVB in an afternoon, and the contagion risk that was associated with that. Those were the main reasons for the large interventions in that weekend to stem that contagion risk. The Credit Suisse is a longer gestation problem, but nevertheless, the sudden death was there as well. So if you look at the stock prices until, let's say, 2020, December or so, it was more or less the same as the overall stock market in Europe, the yellow line, but then there was the decline accelerated by various events that Beatrice will tell more. And it's a warning sign that this is not impossible to happen to some other banks as well, particularly when the mark-to-book ratio of the bank is low, which it was in the case of Credit Suisse, even at the start already, less than 1. And last thing, need for large-scale interventions, I already alluded to those. Those were major. Now, what did we get out of those interventions? Well, first of all, the prices of stocks, bank stocks declined quite a bit, 15% or more in the case of the US. They recovered relatively quickly relative to the stock market. By the end of the year, January 24, we were back into the same level, more or less. And the European case, the bottom two lines, start to converge and actually overtake the general stock market, because European banks benefited from a higher interest rate and higher margins to make up that loss and even improve. The US banks have not been able to catch the S&P 500, but the S&P 500 has been on an exponential increase. So the short-term costs arguably have been relatively limited from that, so the intervention in that sense worked, but I think, as always, the moral hazard is there and the residual problems, in part because the reforms have been slow in the coming. This is, I'm going to focus on the euro area, Switzerland, UK as well, and the US. And the easiest way to do that is to look at the dashboards that the Basel Committee puts out on a continuous basis. So this was a snapshot as of the September last year, so half a year after the crisis. You could have expected some improvement, but there still were many countries. So if you look at the last 4 rows, I'm blanking out here, Turkey, you see the culprits that we're going to be talking about. They were still largely in the yellow, which means that they had not even published they had published the draft regulation, but it was not finalized and it definitely was not implemented. So there were still a lot of laggards. Things have improved since, so this is not in the report, but as of last September, this September, we're talking now about the US falling behind. Of course, we have seen major setbacks in terms of where Basel III may end up in the end game in the US last few weeks ago. So laggards on the reform side, that was not a good sign. In light of the vulnerabilities that had built up over a long period of time, but accelerated, as I said, through the pandemic interventions, the large liquidity. So let me give you here the summary for the US and Europe briefly. What we do for the US is very basic balance sheet analysis. So you take the US banking system as a whole, it's about 24 trillion in the aggregate, and we divide assets and liabilities in a slightly different way than you might typically do. So if I talk about the liability side, where I will start first with, I'm going to focus a lot more on the uninsured deposits, which is actually a very broad category, but anything that's not insured, you can call that an uninsured deposit here. And that's a significant chunk at the Q1 2022, so a year before the crisis, of the total banking system in the US. And on the asset side, where we typically in some sense expect the trouble to emerge, right? In banking systems, it's typically the asset side that goes on and creates the problem. I'm going to focus on the security side, which is the treasury component largely, and GSEs and other government securities that were typically not the cause of the problem, but these were fixed income and they were going to be exposed to the interest rate risk. We know that, but I'm going to show you some data that maybe shed you a slightly different light on what transpired in March 2023. Because the uninsured leverage, so here defined as a non-equity, non-insured part of the balance sheet, so in this case it's 90 out of 100 that I call uninsured deposits, that fraction was very large for many banks. So the typical thing you have in mind is the SVB, and your benchmark with SVB is about 75% is uninsured deposit, that leverage. But that red line here for the SVB case is still not the highest in the system. There were ones that were approaching 100%. And there was a big chunk of banks, these are for 5,000 banks, so small and large, everything is there, that were in the, let's say, 40, 50, 60% range, which is a high fraction in the sense of a vulnerability for a bank to have that, because the uninsured stand to lose their money, so there are run possibilities every day. The other element is the mark-to-market losses. The interest rate increases were sharp over that year between Q1 22 and 23. So as a consequence, the mark-to-market losses on the securities, the treasuries that I mentioned, the fixed income, basically wiped out the equity of the banking system as a whole. So in March 23, you had 2 trillion. If you would have marked to market all those assets, those securities, you can include even the real estate, but it's also at risk, of course. You basically had the banking system bust. That's, of course, the aggregate picture. So now we need to put the two things together for the individual banks. To put the flight risk, the uninsured, and the turbulence together. You can have the low and the high, and we're looking at that distribution. Just to keep in mind here that my flight risk definition here is the fraction of mark-to-market bank asset values. Why do I do that? Because if you have a run, you have to sell your securities in order to fund the run, and then you have to mark to market. And those banks were holding a lot of them not mark to market. So this was the risk that the banks were facing at that point as a fraction of mark to market. SEB is still in the outer quadrant. Higher up in the right top quadrant is the worst, of course, but not the only one. So if I take let's say the 10 top banks in red, where the biggest circle is a bank that's more than $1 trillion at that time. There were many that had high flight risk, and many were having losses that were exceeding their equity base. They're into the 10, 15 percentage points of loss on their mark-to-market. So these were all at risk of runs potentially, and this is why the intervention had to be as large and as significant. Now, where are we now? Now, meaning after the events. This is not the current day-to-day, but there have been updates, and that's published by the OFR and others that are more or less showing a similar picture that, yes, the things are stable in the sense that we don't have the runs, but we do have paid a big price for it. We insured implicitly and even explicitly at some point a lot of more deposits, the uninsured part. We had the bank term funding loan program, which was a huge subsidy. You could bring things that were worth 70 cents for the funding at $1 on par. That mitigated short-term risk, but increased the moral hazard. Because as of March 23, and the picture has moved a little bit to the right, but the total equity, if you mark to market, has shifted enormously compared to March 22. So you go from red to black, and you see that you have about 9 percentage point loss in terms of the median bank, in terms of the capital ratios. But more importantly, there's a big chunk that is below zero if you mark the market at that point in time. That's my 2 trillion number distributed among all these individual banks. And the SEB case was a large one. The red line went from, say, 7 or 8% down to -10, so that's a 17 or more percentage point. But there's not the only one. So many of them were in the losses. So things have improved. The black has moved a little bit to the right, but we're definitely not all the way there. What happens now if we had another shock? The shock can come from, again, interest rates, maybe not so likely, but definitely from the commercial real estate, which is still about to be marked to market in a real sense. We don't have the bank term funding program anymore. We can insure once again, but how often do you want to do that? Lower interest rates. Basically, it's a moral hazard issue and credit risk issue that we're worried about today, should be worried about, in light of my SNL comparison from 1980s on. In 1980s, we thought we had a big mark-to-market loss too on the interest rate book of the SNL, the savings and loans. That disappeared to some extent because interest rates came down, didn't go all the way down, so the gray part was there for a long period of time. But the more worrisome part was the yellow part, the gambling for resurrection of new assets, new lending that transpired as these banks were underwater and had no choice but to lend at high interest rates or attempting to do whatever they could. Going forward, what can we do? The answer is often the same, and in this case as well, do recapitalization in a preventive sense. So here, do a market test, we propose. Look at the banks that have these low ratios and see how much capital is needed. The numbers are actually not so large. If you take that tail and the many smaller banks, etc., Maybe you need 180 to bring them up to 0% capital. Maybe you need 400 if you really want to go down to 5% coverage ratios. The number of banks are significant, so it has to be done by the market. It's not a government program. You have to tell as a supervisor, you need by X day to have your capital situation in order and go to the market. If you can't do it, we need a backstop, obviously, from the government in order to be able to pull that off. Let me move quickly to the European side. European capital ratios improved a lot, partly because of the SSM, partly because of the crisis that they went through. NPLs have declined significantly. A very good story there, particularly for some countries where the drop is even faster and higher, but you go here from 8% down to 2% or so, all thanks to supervision, but I think more conservative issues as a whole. Return on equity was low for European banks. If you take the lowest point, it hit the 0% here in 2020. That was the negative interest rate. The margins were squeezed. Deposits rate couldn't decline below 0 as a consequence of profitability, but has improved as well. And if I were to extend to 2024, we're going to see even a better picture because the banks have returned more to the shareholders over those years. However, they also had the vulnerabilities that I mentioned for the US on the funding side, slightly different, but related in part to the QE, and this is in some sense showing the relationship with the QE. As the reserves increase, which you do when you do asset purchases at a central bank, the transaction deposits, think of it as demand deposits, declined dramatically, increased dramatically as a fraction of total deposits, whereas the time deposits declined. So the funding structure became even more vulnerable at that point as well in the European banks. Now, they did not have a crisis in March 2023 because the interest rate risk was not as large, so there was not a contingent capital mark-to-market loss in the banking book if there were to be a run, and as a consequence, you did not get a run. So this double coincidence was not so much the case in Europe, and I would also say that interest rate was better managed, partly because of regulation. Having said all of that, yes, Europe Bank did not have the run, but we are worried very much from a market structure and profitability point of view. This is the mark-to-book ratio for European banks, both Eurozone and non-Eurozone. And you see that in the Eurozone itself, in March 23, there were very few that actually had a ratio above 1, which is in some sense your benchmark that you don't destroy capital as a bank. Things have improved. Now the average ratio is 0.75, so maybe up by 20%. But we're not out of there. And my last line here, the Credit Suisse scenario, a low mark-to-book ratio, a slow decline, yet a sudden death, is still a situation that you can have in the European banking system. I'm going to stop here. I'm going to pass it to Beatrice. We have a lot to cover in the report, so you have to read it. We're going to pick up a piece of the puzzle here with the GSIP resolution, and that's where I'll end.
Thank you very much, Stijn. Thank you very much, Nicola, for the introduction and for having us here to present some pieces, as Stijn was saying, of this Geneva report. And the one that I am picking up is on the Credit Suisse failure. What can we learn there? And let me spoil it for you. It's not mostly a capital story. It's not mostly a money story, but it has something to do with the question of what kind of reforms have we enacted over the last years and do they work? So which is why it is about the broader too big to fail framework that we are interested in learning lessons from this particular case. I will take a few minutes to step back and talk about these reforms for those of you who are not familiar or not dealing with these kind of things all the time, then go to the Credit Suisse and draw the lessons that we draw from it. So setting up the question of too big to fail without looking at the global financial crisis and the trauma that it caused would be, starting from the wrong point of departure. This is the point of departure, total state support for the banking systems of different countries, and this was not all used. This is just the sum of all guarantees on impact, so to say, were enormous. And hence, the cost, not the direct cost, but ultimately the economic and also political cost of the bailouts of the time were enormous. The stated intention of supervisors afterwards, and this was mostly ultimately dealt with in Basel, which happens to be my home city, and therefore I needed to take the opportunity to advertise the Rhine view of Basel. But the stated intention was never again, and no bank should ever be too big to fail. And what I am doing here is out of thousands and thousands of pages of reforms focusing on two that follow in a straight line from the solvency crisis of the time and from the Lehman disaster of the time. One is a strong focus on capital. It was mostly crises of solvency and therefore equity, improving equity buffers, the quality, the quantity, and also the question of risk weighting or not, and the how to structure capital. Those were absolute key ingredients of the too big to fail framework that was constructed. And the other one I want to emphasize is the experience of Lehman, that the cross-border resolution, that there were no orderly mechanisms for organizing a resolution of a large cross-border institution, that this needed to be addressed, and this was addressed through recovery resolution planning, living will stress testing. There is the question behind it, who actually intervenes, multiple versus single points of entry. Most large global groups have a single point of entry strategy, meaning that the home supervisor is the entry point for resolution. And finally, the enormous constructions of crisis border coordination and crisis management committees that are in place and are meeting for every large GSIP in the world to, in principle, prepare for such an occasion. And let me also say that these were active, they were preparing in the case of Credit Suisse as early or late, whatever you think that is, as 6 months before the actual crisis happened. Stijn has already said that Basel reforms did increase actual equity in European banks, and they also did decrease the balance sheets of large, mostly European global banks. What you see here is the shrinking of the balance sheet of the combined, in theory, combined UBS and Credit Suisse as a share of Swiss GDP. So at the time when UBS was in trouble in the global financial crisis, you see the share was almost 600% of GDP, and now the combined one is something like 200, which is still a lot, and shrinking. So the Basel reforms did do something to both equity and balance sheet size. The Swiss GSIP reforms and capital requirements are a little bit stricter than what the international ones were, I mean, in the sense a bit higher. But what I want to emphasize here is the structure of capital, which has a going concern part, typically CET1, and in Europe, AT1s. Those are convertibles, and I will talk more about those. Those are in going concern, meaning management is still in control. And then gone concern, there is an additional layer of bail-inable bonds. Altogether, this amounts to almost about 30% of equity capital over risk-weighted assets the whole structure. So total loss-absorbing capital is about 30% or about 10% when you express it as a leverage ratio. This graph here is supposed to show the dynamics of a stylized solvency crisis that people had in mind when they designed this. Like, imagine you have a bank that starts out sound and starts losing capital, and then the capital ratio goes down, and if it hits 7%, then the AT1s would automatically convert. In fact, the Credit Suisse ones were designed in this manner. They would automatically convert at 7%. But there was another clause in these contracts which said that even if it's not at 7% or has not declined to 7%, I'll tell you in a moment that Credit Suisse is such a case, the supervisor can convert or write down, in this case it was a pure write down instrument, if there is a viability event. And this viability event means some state support. Now, if the AT1 still following the logic, if you have done the AT1 bail-in, but it does not lead to recovery, instead the bank keeps losing money, then is when you get to the point of non-viability, that's the PONF. And at that stage, it enters gone concern. So the way that I like to think about that is management hands over the keys to the supervisor, and the bail-in of the bail-inable bonds is conducted. That's the theory. This is how it is. Same graph, just in a bit more. You don't see the time dimension here, but it is the same graph. This is taken straight from the FINMA website, the Swiss supervisor. So you have the recovery phase, and then you have the point of non-viability, and then you have the gone concern TLAC bail-in. And this is the reason why this is different from the graph I showed you before, is because there is also the Swiss emergency plan, which is something that essentially ring-fences Swiss retail functions, and then should lead to some kind of orderly wind down of the rest, which is when the bail, this would be the emergency plan if the bail-in failed. The reason why I'm emphasizing this is because there was a lot of confusion, and still is confusion. People sometimes think that what could have happened after the point of vulnerability is going straight to this kind of bankruptcy type of emergency plan. That was not the point. It would have been the bail-in of the bail-inable debt. So this is the first real-life test, and this is what happened. These are the numbers. The ones that I want to emphasize here is that emergency law was needed in order to put together this package. The government took some loss guarantee, second loss piece guarantee. So there is a bailout element to it. But the most important reason why emergency law was needed is because the liquidity backstop had not been in place, and the Swiss National Bank required a liquidity backstop from the government in order to provide liquidity funding and resolution, essentially. And that would have been necessary in any kind of choice that they would have taken. The number to emphasize here is that it was 170 billion liquidity at peak that were needed, and that is, of course, a huge amount compared to a balance sheet of Credit Suisse of about 600 billion at the time. And largely in US dollars. So it's not something that Swiss National Bank can print themselves. It was not a solvency crisis in the narrow sense of the word. Assets were greater than liabilities. Equity at demise was actually there. So the total TLAC of Credit Suisse was about 100 billion out of 250 RWAs, so almost 40%. And even if you don't like risk-weighted, you have 15% more than the minimum required of TLAC in the balance sheet at demise. So it wasn't a capital crisis, but it definitely was a crisis of the business model. The franchise value, book to equity, and equity prices had been going down steadily, as Stijn has already shown. So the trust that expected returns would cover expected costs was not there. The main questions that were asked in terms of lessons: why was the PONF not activated? Why wasn't the bail-in done? And there are several reasons that we could name. I don't want to go through all of them, but one of the main questions is, what do we need to do? Where was it missing in order to make the bail-in credible? Because that is what the resolution would have prescribed. Let me emphasize one: there were legal challenges around the bail-in. A lot has to do with the question how the SEC would have responded. They think that they had those under control. there are a lot of questions around whether, I mean, what would have happened if they had done the bail-in on the next day? Because, of course, if you have a business crisis model, then the business model does not change immediately. But overall, the bottom line on the bail-in is that it could have been done, and the supervisor had, in fact, prepared it. Let me raise one last point. If the bail-in, so one of the lessons is we need to make sure that the bail-in works, and therefore the resolution framework can be applied. Credit Suisse actually, even though it wasn't fully applied, suggests that that framework is not broken. It needs some repairs. Where in the report we put a lot of emphasis is that moving the game forward, and it's not only the credibility of the end game, but of the recovery, that where more emphasis should be. In particular, we suggest that we should have an early intervention regime which is binding in the following sense, that either the supervisor intervenes in a orderly, in a predictable way according to a certain set of triggers, or explains him or herself if they choose not to do so. Something like a bit of an extended prompt corrective action system as the US has. This idea of an early intervention, special recovery regime, I think is something additional that we emphasize in this report and which is not already a big mainstay of the current debate. So let me step there and thank you for your attention. We move.
Well, first of all, thank you for giving me the opportunity to say a few words on this topic and the report as a whole. I like the title, and I enjoyed reading the report. And of course, it covers many, many issues. So given that I have roughly 10 minutes, everything I say is going to be rather telegraphic when it comes to the comments here. The report essentially covers many, and let me stress, different things. Because the first one is the SVB collapse and what happened in that particular case. The second issue is EU banks and the regulatory framework, or the lack of a regulatory framework in Europe, depending on how you look at it. And then we've just heard about UBS, GC issues and what it takes when you actually have to sort out the mess that it happens in a very, very large bank. And then, which no one has touched on so far, is the connection between monetary policy and financial stability. And let me add myself a fifth issue, and that is above all of this hovers the political economy of bank regulation and central banking. And that is, of course, something that always complicates things and complicates things very substantially. First on SVB, and the story is well known, so I'm not going to go through any of the details at all. But clearly we have some remaining issues when it comes to hold to maturity versus available for sale. And it's probably worthwhile to look at the accounting rules and how to sort of treat and how to think about these things. I'm highly biased myself when it comes to this. I'm always in favor of transparency. So if you argue that you hold everything to maturity, somebody else will market to market for you. And you're actually better explaining yourself what's going on compared to having others doing it for you. So that's a remaining issue. When it comes to the Basel Committee work, keep in mind that the Basel Committee just recently had its 50-year anniversary, and the liquidity coverage ratio and the net stable ratio showed up very, very late in this work that has been going on for a long, long time. And that means that it's probably worthwhile to look at the LCR and the NSFR again. It's too early to tell what is likely to come out of that. Also, what has struck me during my almost 8 years as chairman of the Basel Committee is that there was never an interest in dealing with interest rate risk. Each and every time the committee touched the topic, we were told to stop. And others have paid for that. That is obvious. The other one, which the report doesn't cover at all, is of course sovereign risk, because essentially states prefer to grant themselves favors. That's another way of putting it. EU banks and EU bank rules. Well, the EU, when it comes to the banking union and the capital markets union, is an incomplete system. And I agree with all those views that you find in the report. And I do think that given the fact that the price to book in European banks has been below 1 for a very, very long time, that's a very serious signal that something is seriously wrong in the system. And I have many times come across individuals who have said, well, you know, Europe is bank-centric. It's important with banks in Europe. That's true. So you should be kind to the banks. It's okay in Europe to run banks without capital. If your system is bank-centric, it's actually absolutely the other way around. Then you should make sure that the banks have lots of capital and not too little capital. And in Europe, we just can't solve the political issues around this. And I'll get back to this in a short while. In addition to that, of course, we need to have a more ambitious goals when it comes to both the banking union and the capital markets union. And as long as that does not happen, Europe will be kind of stuck with these problems. The third issue, UBS, GSIB, or GSIB rescue. Bail-in looks good on paper, a lot harder to do, because you have to decide at 2 o'clock in the morning how to do this. So we probably have some homework to do also on that side. And this is sort of overwhelmingly technical, sometimes just too technical. And it's not really about supervision and central banking. It's basically all of it corporate finance. And in order to do the bail-in in such a way that you understand what you actually are doing, you need to be a corporate finance specialist. And most supervisors and central bankers don't have that experience. And that's a dilemma in itself. Central banks are lenders of last resort. Nowadays, they are market makers of last resort. And in a number of cases, de facto, like it or not, you also have to accept that governments tend to become owners of last resort. Because if there is a problem which is large enough, there is no one else around. So we have some homework to do here, and it's much more than just a weekend exercise. Because once you have done the bail-in, or once you have taken over the bank in one way or the other, it takes a long, long time to actually restructure that institution. And I have many times asked myself, if you do a massive bail-in, are those new shareholders actually capable of running the institution? Because you end up with a random composition of shareholders. And I just don't know the answer to that. So there aren't really any easy answers to this, and as was already pointed out, we have some homework to do in this field. Finally, on monetary policy and financial stability, which is which hasn't been commented on, but which surfaces also in the report. As a practitioner, I think it's actually an intellectual failure that we have never been able to sort this one out. Because without financial stability, you lose the transmission mechanism, and then you have basically lost monetary policy as well. So clearly, monetary policy and financial stability are interdependent, but in a way that we simply have a hard time to handle. Let me mention to you 2 examples that I know from within myself. Back in 1996, in Sweden, we had put the banking system back together. Rates started going up all over the world, particularly in the US. And we had to calculate again at what level of the policy rate would the banking sector fall apart again. And that meant that clearly monetary policy was constrained. Something similar happens when we work our way out of the pandemic and inflation goes to 10, 11, 12%, depending on where you look at it. But in many, many cases, that is what happens. It's obvious that policy rates have to go up. When they go up, in the case of Sweden, 75% roughly of the mortgages are variable rate mortgages. And then you, of course, have to grapple with the issue, when does the housing market die? And what does that do to the economy? Now, this time we survived because rates started going down before we reached that level, but it certainly remains an issue. And on all of this, you can say, well, do macroprudential. But macroprudential is just another way of raising the policy rate without raising the policy rate. But it's never expressed that way. And in that sense, I'm pretty much on Jeremy Stijn when he talks about monetary policy getting into all the cracks. But we certainly haven't sorted this one out. What is not in the report, and this is absolutely not a criticism of what is in the report, is really the political economy of all of this. And my feeling is that this is a topic which is under-researched. And that's because there is a time inconsistency in all of this. And it's a time inconsistency which is very similar to the difficulties that we struggle with when it comes to global warming. Because somebody has to say no today in order to avoid disaster in the future. And it's hard to say no, and then the political economy of the whole thing is very, very much such that, given that it is not possible to do that, and here the interest of the private sector, banks, and the politicians, those interests usually coincide in the short run. And that means that if you are a regulator, you are pretty much left alone because you have a bunch of politicians coming and tell you that you are an evil person. And at the same time, the bankers tell the politicians that you are an evil person. And still you are supposed to say no. And then it takes a pretty strong regulatory framework or strong individuals to stick to that. And that's why I do think that we have some work to do here. A simplification when it comes to describing this is to base, and this is my conclusion from having chaired the Basel Committee for almost 8 years, as I said, is that the Basel Committee's work is roughly 2/3 regulation and 1/3 is politics. And politics in the short run. And when it comes to the 1/3 that I just mentioned, I would say that half of it is domestic politics, and the other half is some kind of a game about global market shares. And this is what ultimately produces the regulatory framework that we have, and it also actually produces the holes that we have in the global regulatory framework. And that's why some of these rules and regulations intellectually might be just fine, but as we saw on one of the charts, they are either badly implemented, not implemented at all, or very, very seriously delayed. And that means that rulemaking is cyclical. Things blow up. You strengthen the rules. As soon as the ink has dried, the dilution process starts until the whole thing blows up, and then you start over again. Thank you.
Thank you so much, Stefan. Thanks to all the speakers. As you said, Stefan, there is a lot to unpack here, maybe too much, but that's our predicament this morning. I would invite the 3 speakers to join the stage if you will. You mentioned, Stefan, the fact that bailed-in creditors of failed banks become shareholders. My favorite example of that is when Hellenic Bank collapsed in Cyprus in, I think it was around 2013. I think the largest shareholder as a consequence of the bail-in ended up being a company called Wargaming.net, which used to be headquartered in Minsk, Belarus. And that was, of course, as its name suggests, a video games company. It's well known for World of Tanks. And that was the largest shareholder of the bank. Now it's a happy story because they ended up selling to Eurobank, and now it's a good example of cross-border banking consolidation in Europe. So lots of food for thought. Maybe I will ask, we have limited time left. I will ask Stijn and Beatrice to react to what Stefan said if they want to, and open it to the floor. If you have any questions, there is a microphone here. There's also, I guess, a roving microphone in the room. Stijn?
No reaction. For the political economy, that's the most difficult part, but I think that's for a different science to address that.
Maybe just one point that I did not get to emphasize enough, and that relates to the political economy, as you put it, in terms of timing consistency. One of the problems of timing consistency, and not only timing consistency, but really also of incentives, is the fact that if you have a picture, as we were seeing for Credit Suisse, of a slow decline and sudden death, with at the same time capital ratios, so the regulatory ratios are actually okay. So the question is, when do you intervene and how, and what is the early intervention set of triggers that you would like to have in place in order to change the incentives, which at the moment I would describe the following way. You have typically a management, in the case of Credit Suisse.
But Beatrice, if I can challenge you on that, isn't the lesson you gave us from Credit Suisse that the Swiss authorities intervened actually at the right time? Because they intervened at the time when the bank was still solvent, in your argument. So what went wrong here?
No, that was a bit late, because there was the run, right? I mean, I didn't emphasize that. There was a first big run of the wealth management in October, and at the time there was, the bank was, that's why they needed so much liquidity, right? So it was the moment where the run is becoming absolutely widespread. So what they did stopped the run on the next day. That's correct, and in that sense it was a success. But my question was more, or for the question for the political economy, moreover for the framework, is what kind of recovery regime would make sure that there is a much earlier and sufficiently large intervention by aligning the incentives both of the markets and the management and the supervisors, by forcing them to a certain extent to intervene earlier, right?
So there's something that Stefan suggested which caught my attention. He spoke, of course, about sovereign risk. It's not our issue today, but he did speak about interest rate risk. And here there's a contrast, at least the way I understood it, between what happened in the US and what happened in Europe, for that matter, including the Eurozone and the UK. So Stijn, I think you alluded to that in your presentation. What exactly explains that the interest rate risk was with a shock in interest rates, which was very similar on both sides of the Atlantic? If you look at the Fed, the Bank of England, the ECB, the trajectory of policy rates was extremely similar. So why is it that this shock triggered a crisis in the US and not in the Eurozone and not in the UK?
So interest rate risk was better managed in the Eurozone. So there were rules on the books that were being enforced, where the discretion that banks had in terms of how much interest rate risk they could use was much less.
Sorry to speak jargon, was that Pillar 1 or Pillar 2? Was it the actual rulemaking, or was it the supervisory discretion of the authorities?
As Stefan said, the Basel rulebook does not include interest rate risk because there was no consensus on that, so there was no choice but to go for Pillar 2 in the European context. But nevertheless, it was enforced, and we saw less of it. The other thing, of course, is there was a lot of more asset purchases in the US and Europe differ quite a lot on how the central banks implement monetary policy, whether it's through the banks or more through open market operations, which reflects itself also in the asset composition, because many of these banks then ended up awash with liquidity, and some of those less well-managed banks like SVB ended up seeing no choice but to invest in fixed income and actually started to take more interest rate risk as the crisis progressed on their own balance sheet. So that's the perversity. They stopped hedging and actually took on more risk. But the moral hazard part of it was very substantial. Luckily, Supervisory Europe did a better job.
Stefan?
Just let me add to that, that in those cases when interest rate risk is handled in Pillar 2, that's kind of, in some sense, soft law. So it's much more easy to challenge Pillar 2 than Pillar 1, because Pillar 1 is hardwired. And either you break the rules or you don't, but Pillar 2 is kind of mushy-mushy. And that's why it's much harder to enforce.
Are you implying that the more legalistic US context makes it more difficult for supervisor to exercise necessary discretion?
It depends on the legal framework in the respective jurisdiction, because if you have a legal framework that gives you strong powers when you enforce Pillar 2, then you can do it. But if the legal framework is in some sense weak or non-existent, then of course the supervisors can tell a bank to do this, that, and the other, but more or less you can ignore it or you can go to court.
I have tons of questions, and it can be a bit dangerous, but I would prefer to have questions from the floor. There's a microphone in the middle for anybody who would want to use it. If not, yes, please.
College Emeritus. I was surprised, Beatrice, if I understood you correctly, you seem to be calling for more prompt corrective action in the European case, but in the US at least, it wasn't prompt and it wasn't corrective in both 2023 and 2008. But on Stein's graph, where you saw the market to book value declining so precipitously, or what do you think of the possibility of the Calamirus herring type solution of earlier mandatory conversion? So looking at that graph just very quickly, it seemed like if the conversion took place in, say, May or June of 2022, life would have been a lot simpler and cheaper.
And we'll take another question because unfortunately we have limited time left, so let's go right away and take the two questions together.
In the case of, it's Miranda Zaffa, EF Consulting. In the case of Credit Suisse, is there any merit to the claim of 81 bondholders that shareholders should have been written down to zero before bondholders lost all their money? I understand there are some lawsuits pending, and I was wondering, is there a legal case in favor of the bondholders? Thank you.
So that is perfect because we have one question which is mostly about the US, the other mostly about Switzerland, one question about early interventions, the other about crisis management and resolution. So let me go through our three speakers in the order they spoke, Stijn, Beatrice, and Stefan. Any final words in addition to answers to the questions that you may want to give us?
So prompt corrective action, I think, would be useful if it were complemented with some other indicators, and we've been there for a long time. The risk is always that you have a debt spiral where you focus too much on market indicators. My preferred, maybe we differ within the team on this, is not to bake it in too hard in the sense of having a rule, okay, if prices fall by X or something like that, do Y. I think then you run into this kind of issues. But make it a little bit more about accountability of the supervisors and saying, okay, if X triggered is reached, you have to report to your internal board or to the Minister of Finance or whoever is your accountability governance regime, why you did not do X or Y. And you should be doing something on the management side. In the end, as Beatrice mentioned as well, it's preserving the value that's in the bank still by correcting the management deficiencies. So SVB had them. I think in the US, the signal from the supervisors was very weak in spite of a rule book that was quite extensive. They were ignoring and they were not acting on it, and that came from the top, I suspect, that signal was given. That's not what you want, but I can't correct it by rules either, of course. I have to look at accountability. Now, I think the supervisor in the US paid a price in terms of reputation. If you come out with a report that only blames yourself for all the failures, that doesn't look good. So hopefully that will discipline to some extent the system, complementing by market indicators.
Let me just also reinforce this point that prompt corrective action, we are not, or in my view, what we don't need is exactly a copy of a prompt corrective action of what the US is. What is good about prompt corrective action is that it is actually binding, and therefore it has some forcing effect on the supervisor. But it was not good is that it's too narrow, and for instance, in the Credit Suisse case, it would not have caught because, again, you know, it's basically all about capital, and Credit Suisse was not all about capital. So you need a broader range of triggers, and the early intervention measures of the EU framework are actually broader. They include things like events. You know, large loss events can also be a trigger. And as we put it in the report, what you would need is probably some kind of set of rules that trigger such a regime. And if you don't trigger, then as a supervisor, you have to either you have to explain publicly why you did not trigger, why this case did not actually conform to the expectations of the set of rules. But essentially, it's about a question of rule versus discretion, reducing the discretion of supervisors' timing in terms of their intervention. The second point that you asked about the 81s, well, the 81s are in principle the buffer that should automatically lead to recovery in going concern. Now, in going concern says that equity still has some value, otherwise you are not in going concern. And therefore, the design of the Swiss 81s, which was this, namely either a 7% automatic write-down, not conversion into equity, or in case of a liability event, is compatible with this idea that this is going concern. Now, I'm not a lawyer. I'm not going to be adjudicating these lawsuits, but I have read, and you can read it easily, the prospectus of the last 81s of Credit Suisse, and it's in very, very plain English. Actually, it's all capitalized. You must read this, and so on. So it's not difficult to read what the contract said. And it said that this could happen, that you would be written down to zero, and it says nothing about equity still also has to be worthless. In fact, if equity was worthless, it would not be a going concern recapitalization, it would be a gone concern one.
A simple view is that get rid of 81, jack up capital. It's not harder than that.
That's one, that can be one response, yeah. Or fixing them is the other.
On prompt corrective action, Stefan?
I don't have a good answer to that. It's just hard. If you have a lot of if you have the opportunity to use prompt corrective action, you have to make sure that you have a very strong legal framework backing you up, because otherwise it ain't gonna happen.
Lots of unfinished business, lots of food for thought in the 27th Geneva Report. Thanks so much to Stijn, Claessens, Beatrice, Weder, Mauro, and Stefan Ingves for very stimulating inputs today. And we reconvene at 11 with Agnès Benassi-Kéré. Thanks so much to everybody in the audience.